scalability is the secret to success. If you look around at every successful company, it's not how much revenue they're making on each product. It's not marginal revenue. It is scalability. As long as they're able to make $1 or 1 penny, as long as they're making more than they're spending, they can make enough products and they can become huge. If you can't scale, if you're selling something that just cannot scale, I don't care how much money you're making on that. You could be making 3,000% returns. You just will never get there because there's no room for growth.
Your network is your net worth. Come listen to some of the most successful people I know share invaluable knowledge, stories, and advice in real estate, business, and beyond. This is Weiss Advice. Whether you want to take your business or personal life to the next level, look no further. Welcome back to Weiss Advice. I'm your host, Yonah Weiss, and it gives me tremendous pleasure that you guys are joining me today and listening to this podcast, and keep listening. So thank you again for joining in. And I have someone today that it's one of my greatest pleasures. You know, he's a good friend. He's someone I've known for many, many years, probably about 15 years. We go back, you know, just one person that I look up to, and I think you guys should too. So welcome to the show, David Weinstein.
Thank you very much. I'm happy to be here.
David is a rock star. Okay, guys, a little bit of background about David, because if you don't know him, you probably don't. He's not like on social media like me. You know, he's not all over the place. But one thing you should know is that, first of all, he's the CEO or the acting CEO of Arion Fund. Okay, Arion Fund is a private mortgage company. They give loans to basically anyone who's a commercial property owner, hard money loans, things like that. Really amazing things. He's done over 250 loans. Okay, we're talking not someone who has been, you know, just off the cuff doing this stuff. He's right now gone back to school. He's going to getting his MBA. And I think just a person that I look up to because he's constantly growing, you know, just like me. So that's that growth mindset. It's not just sitting in one place and doing one thing. It's what can I do to become greater? And, you know, to be honest, David, I think you have some of the best business ideas like I've ever heard. So, you know, just all these great ideas that keep coming up, you know, all the time. So without further ado, David, or Dewey, like I like to call you, what's going on?
All right, great. Wow, with that introduction, Yonah, can you do that one again? That was so great.
We recorded it, so you can listen to it as many times as you want.
I think I will. Thank you very much. It's great to be here on Weiss Advice. It's one of the wonderful podcasts. I think anyone who has any spare time should be listening to this. You'll just get invaluable information from Yonah. And, you know, like Yonah said, we've gone back many, many years. We're worked together in several projects, and you know, we're close personal friends as well. So
yeah, that's right. In fact, I think I owe you probably, I mean, you know, I look at it as divine providence. Okay. So when a few years ago, when I was looking to get looking for something to do, this goes back about 5 years. We just ran into each other one day, and I said, "Hey, I'm looking for a job. I'm looking for something, you know, looking into getting into real estate, perhaps." And right then, you were like, "Hey, my uncle's starting this, you know, little firm, this finance firm. You want to come work together with me?" And we literally sat side by side, right, in a little office, just the two of us, working remotely and trying to close deals, close loans, originate loans, doing all kinds of stuff. And I learned so much about real estate in general, right, and commercial real estate specifically from those months together. So I owe you a tremendous debt of gratitude for that.
Absolutely. Those are great times.
What are you doing now? What's Arion all about?
All right. So Arion is essentially an alternative commercial mortgage lending company. We're coming in with loans, kind of bridge lending, hard money lending in spaces where traditional banks either don't do or don't do well. We are first position mortgages in the sense we're a commercial bank. In another sense, we're short-term loans. So we're kind of this very niche specific kind of lender where it's pretty much industry professionals who are aware of us, who come to us and get our type of mortgages.
Yeah, and you know there's always a need. You know, finance, you know, having money to close a real estate deal is, an integral part. And I think it's incredible. There's no other, and correct me if I'm wrong, no other investment vehicle that exists on the planet that you can actually have someone else pay for, right? You can have a bank or private, mortgage company or something pay for that, or a large majority of that investment, and you can collect the returns, on that investment. I mean, are there any stocks, any type of other things you're aware of that, besides for real estate, that you can literally put 20%, 10%, down payment, and you collect the interest, you collect the returns?
Well, it's kind of like all lending, like all debt and credit markets. There are it's kind of an old product. It's just reinvented for the real estate market. Companies, they'll take debt to leverage. It's this really kind of neat financial vehicle where people realize that any item or asset can be broken into two categories. One is low risk, low return category, and the other is high risk, high return category. So basically any asset can be divided by those two features. Lenders coming in the space of the low risk, low return space, they'll say, we'll put money in and we're going to cap what our returns are going to be, and that's called interest. But in exchange for capping our returns and not getting these, invaluable upside, we are going to only take losses after you, or limit our losses in some method or form. So essentially that works for everyone. So the people coming in on the other side, the high risk, high return, which is called equity, essentially they are happier to take higher risk. They'll say, no problem. If there's a loss, we'll take the first loss. You won't lose anything, but we get all of the upside above what the interest or fixed return that you guys are getting. So it's really it's worked out over hundreds, if not thousands of years, this kind of arrangement, and it kind of works really well because it satisfies different risk return appetite.
Right. So yeah, I guess you're right. That does work with other types of investments, other type of business investments as well. But what
you're right about real estate though is that it is exceptional in the fact that it appreciates on its own with kind of a mind of its own. So where you have let's say another company, let's say you're a Tesla, you're a car company.
Yeah.
It doesn't appreciate on its own without putting in a tremendous amount of assets, of resources, time, development, research. Real estate has this kind of unique value in that it can appreciate without doing anything to it. So that appreciation is captured by the equity holder and not by the bank, not by the lender. So you've got this really, really cool, and in that sense, Yona, I think you are absolutely right. I don't think there's another asset in the world like real estate in the sense that it appreciates on its own. I think people don't appreciate that the way they should. People kind of look at returns in the sense of what is the rent, what is the NOI, what are the cap rates. Mm-hmm. Typically, cap rates will not include appreciation, simply because it's not really a calculable number that you can put on your balance sheet, at least not year 1 and 2 and 3, and it's kind of unknown. It's a little bit hard to predict.
It's hard to predict. There are some historical predictions of appreciation, but yeah, it's still something that you can't necessarily predict 100% of the time. But going with that premise that this is an asset class, real estate, commercial real estate in particular, that has its own appreciation inherent, and like I mentioned before, which is what you do, is that you can go to a bank, right, or a lender and take a loan on that. And yes, any type of business, you can get a loan and you can exchange a certain amount of returns, those low risk returns to that lender for this. But as an investor, as an individual who wants to invest in real estate, right, now I guess you would look at it like a business venture as well. But I like to think of it like you can't go to, and the example I like to give is you can't go to buy, $1,000 of Apple stock, right? And say, you go to the bank and say, hey, can you lend me, I'm going to put 20% down to buy this Apple stock, and you put the other 80%, and I'll take, the returns. Okay. Now you could take a loan out from the bank, right, and pay interest on that, but it's not exactly the same idea.
Correct.
Yeah. So in that sense, it is a bit different. Now, one thing unique about Arion, which I love, is that you guys are really an international company, right?
Correct. Yeah, we're kind of interesting in our space because we're international, like you said. We're a startup. We're essentially an Israeli tech startup. If you want to, it's always good to throw tech into anything. So we like to call ourselves a tech startup, but we kind of have that fresh vibe of a startup. At the same time, we're kind of institutional in the sense of being a lender in our structure. So yeah, we work very heavily on that structuring. The structuring of being international means dealing with tax, international tax law, structuring vehicles that work across countries well.
Yeah.
Money transfer from all levels, from dealing with governmental monetary law all the way down to which bank will have the best wire fees for international. So it really brings in a new aspect.
A totally different component to a regular, a normal bank, a local bank, or a local private lender. So you guys essentially have, it's an Israeli tech startup, right? Basically, you have investors in the Israeli tech space, right, who are coming in, investing in these. I don't want to get into the complexities of the structure of this investment vehicle, but essentially what you're doing is not just, having a fund where you are providing loans to commercial real estate. It's also combining that with, this product that is really scalable.
Correct. And yeah, I without getting, like you said, into too many of the ins and outs and the nitty gritty. Of course, anyone can reach out to me if they're interested down the road. But the big vision and the way that we're different, I have to credit Ariel Lerner for his vision in this. So, we started together probably in end of 2015, beginning of 2016, and he had $1 million of startup seed money, not a lot. And he basically said, we're building a public company. And I was like, listen, Ariel, why don't we just get the highest returns on our money, because there's not a lot of it. And he's like, no, we're not looking at returns. We're looking to build a public company. And what he meant by that was, think long-term, how can this scale? And scalability, like we know, is today, and we see that. I saw that play out, and I come to agree with him and see the wisdom of that. Is scalability is the secret to success. If you look around at every successful company, it's not how much revenue they're making on each product. It's not marginal revenue. It is scalability. As long as they're able to make $1 or 1 penny, as long as they're making more than they're spending, they can make enough products and they can become huge. If you can't scale, if you're selling something that just cannot scale, I don't care how much money you're making on that. You could be making 3,000% returns. You just will never get there because there's no room for growth. And examples of those would be kind of service businesses. If you're somebody who sits in a financial advisor, and there's no offense to any financial advisors listening to this, you only have 24 hours in the day. You cannot get more hours. So you have to, and if you want to grow, you have to charge more, and there's a ceiling to how much you can charge. What you can do if you're a financial advisor is open up a firm, hire people under you, and keep some of their money, and there is scalability there. So getting back to our company, what we did, what Ariel's vision was let us figure out what we need to do to be able to scale. And the answer to that was build a fund. Now, just to explain very briefly what that means, there are two ways of going about lending. There are matching investors with loans. So you can find a loan, find an investor. You need $100,000. You want to put in $100,000. I'll take a small fee for syndicating it, and everyone's happy. Then there's another way to do it, which is building a fund, saying we're just finding investors. We're finding thousands and thousands of investors, and they're putting money into this company. On the outside is we're finding hundreds and hundreds or thousands of loans, and we're putting money out. And we're pooling the money. All risk is shared. All returns are shared. And you get a tremendous upside of security because you are be able to access the kind of get closer to the average return, which is very important in a company like ours. So that's what we did. We built a fund. We structured it. We raised money into this pool. Sometimes we have excess capital with no loan and we're paying returns on that. That hurts. But in the long run, we're able to attract much, much larger investors than we would by trying to pool one-to-one.
Right. So just switching gears a little bit, have you found, because you guys obviously are putting out a lot of loans, you guys are finding investors, with the current environment, which has, taken the world and this country by storm over the past few months, the COVID obviously I'm referring to, and there's been a slowdown to the market, to the real estate market, and everyone's felt that. Have you guys as lenders felt that slowdown, meaning people are doing less deals? And just a follow-up question on that, what about, are people defaulting on loans? Because I remember, back in 2008, that was one of the biggest, things that happened in the downturn of the market, the recession, was that people were just defaulting on loans left and right.
Right. Yeah. So that's a great question, a very important question for these times. Let me answer both of those, essentially two questions. There has been a slowdown in the market. Absolutely. Right at the beginning of the pandemic, probably end of March, mid-March to beginning of April, there was chaos. Nobody knew what would happen. People were stopped everything. They stopped communicating. They stopped coming out of their houses. They stopped looking at investments. Listings were delisted in the residential space, in the commercial space. It was chaos. So there were not a lot of new deals. There were not a lot of new properties on the market, not a lot of trading going on. So yeah, so we, as our fund, like many other funds in our space, we put a halt to new origination because we didn't know where this was headed. We didn't know if this was the end of the world. We didn't want to put money out in such an environment where there's no playbook, no rules, no futures, no historicals to plan with. So we stopped lending altogether. We still had an active book of loans, so that was another problem, which touches on your second problem.
Right.
But I'll get to that. Just regarding what we're seeing today, is we're seeing things open up. Deals are coming back on surprisingly quicker than I personally thought, quicker than I think most people thought. Things just picked up, which honestly concerns me. It doesn't make me happy because I don't think people are getting the full scope. I don't think we're there yet. We haven't hit rock bottom. So people, getting all excited that the market is back I'm afraid might be opening themselves up for disappointment. We're still being very cautious with our new originations. Only looking for the safest deals right now. Now, as far as our existing book and foreclosures, so I was expecting the worst. I mean, we put out notice to our investors that they would be we halved our forecasted returns for the year. Surprisingly, the returns pretty much stayed the same. The payments stayed the same, which was really interesting to me, which made me think a lot because, people didn't really stop paying. I think there was a combination of factors, and I've heard this from other lenders in the space. First of all, the government flooded in the U.S. The government flooded the market with money. I mean, there was free money. There was whether it was the PPP, the high unemployment payments, all different sources of government money came to the market, stimulus money, and that really kept things afloat. People were able to, tenants were able to pay landlords, which means landlords were able to pay their mortgages, which means we got paid. So really the market in our real estate bubble kept on working. Now, you asked, how is this different than 2008? It's very different. So far, we're seeing a huge difference. Where in 2008, there was a specific market called the housing market that was a bubble. So what that means is that there were fake values assigned to houses that weren't really there. Now, like Yona, in your space, valuing real estate, valuing houses are complex. There is no real value. There's no market. It's not like the market for fruits or vegetables. It's because it's not transportable. Every house is unique. Every house is different. Even if it's identical in structure, it's different in component. It's in a different location. Another block is what causes value to change. So valuing real estate is extremely difficult. And then the mechanics of the real estate, the age of the real estate, the age of the roof and the mechanicals and the HVAC and the heating systems, all this stuff makes a huge difference in the value. So in 2008, you had a overvaluation because of various reasons and oversight and weak oversight. You had a lot of overvaluations in real estate and housing. So the numbers that people were paying, they were not actually paying. It was not actually worth it. Nobody was paying for it, really. Essentially, it was a mortgage-backed securities. Banks were paying for it, but banks themselves were not paying for it. It was investors and the stock market that were ultimately paying for it, which were through me and you and people's pension plans. They were paying for it. That was a very real estate specific problem. So when that popped, that bubble, it affected real estate first, and then the rest of the market, of course, paying together because it was dragged down with real estate. Here we're seeing something different. Here we're not seeing a real estate problem in the sense that the prices are not specifically overvalued. The real estate prices are reasonably within where they should be. Again, those are very general terms because who determines where it should be? It's determined by moving parts like markets and stuff. But essentially, people are not concerned about a bubble right now. Analysts are not concerned about a bubble. We're coming at the problem from a different direction, which is the pandemic, of course, and the markets that those are hitting, and that leading to real estate being hit. So if the pizza shop shuts down, all of those employees might not be able to pay rent, which will hit the bottom line of the real estate value. So it's coming from a different direction. It's hopefully, and our vision is that it's not going to affect real estate as much. And again, we won't know until the market levels out, which might take a year or two.
Absolutely, incredible insight in in the current situation, and this is very current. So I hope a lot of people find value in this. And David, I appreciate all of your insight on this and getting to know you and Arion Fund a little bit more intimately. I think it's been very beneficial. But we're running out of time now, so I do want to jump right into the final four. So let's get into this. First question for you is, what's the worst job that you ever had?
All right, so that's an easy one. At one point, a couple of years back, I transitioned. I moved to America. I was living in Israel at the time, as you know, Yona. And I came here, and my father-in-law offered me a job. That was by far the worst job I ever took in my life. And I'm banking on the fact that he's not going to listen to this. It was working in a warehouse. He's a wholesaler. He sells gift items. I was working in a warehouse packing boxes, and that was just not for me. So I did that for about 3 weeks, and I bombed out. I came home, I told my wife, I'd rather, sweep floors than work all day in this warehouse. Compounded with the fact that it was for my father-in-law was just easy off.
Yeah.
Worst job ever.
Absolutely.
Next.
Yeah, next. Right. So what's a book that you've read that's given you a paradigm shift?
All right. So yeah, I got into reading more heavily recently. I just see tremendous value in reading. In that, you'll have sometimes, tens of years, decades of years, scores of years of experience of people who spent their life in a certain arena, whatever that may be. They're passing that information onto you in a book. So you can absorb essentially your 40, 50, or several hundred years if there's research compiled in that book. You can absorb that within a couple of days. I think reading has tremendous value in learning. So one great book that I read, I think this is the best book I've read that I can recall, is a book called The Power of Influence by Dr. Robert Cialdini, I believe is the name. I'm not sure if I'm pronouncing it correctly, but this is a book that is kind of a social sciences book that studies how people react without realizing it. So it's a lot of subconscious thinking and research, and it blew my mind in how and the vast difference between the decisions that we think we're making logically and the real reasons that we're making those decisions. And it's kind of helpful for business as well in understanding how to get things done. It's not always intuitive. It's not always about, the bottom line or money. It's about how people feel and how people act. I think that book transformed the way I deal with people as well.
100%. That's looking into that. So that's going to be in the show notes over here, The Power of Influence. Question number 3, what's a skill or talent that you would like to learn?
So that's a tough question. There are a lot of them, but I think coming off the last question, I would say that I would like to learn how to speak to people in a way that influences them, because I think ultimately most jobs can be replaced by machines that can do it faster and better than we can, except for one thing, which is thinking. I don't believe that AI will outpace human thinking in terms of cognitive awareness for a very long time. So the power of speech and the power of communication with people, verbal and nonverbal as well, is something that I would like to learn as a skill to get better at. I think that's unbelievably powerful.
It's definitely a great skill to have, great talent to have. There are many, many books that can help with that for sure. One that just comes to the top of my head right now, and again, there's so many that deal with this that I've read, but one just pops out to me, which is How to Win Friends and Influence People. That's, a classic, but the 7 habits of highly successful people. So Stephen Covey goes into a lot of the emotional and, kind of psychological dealings with how to communicate and, dealing with win-win situations and that whole thing. So a couple of those, I'll put those in the notes also, but anyone looking to be interested in that as well. Fourth and final question is, what does success mean to you?
Okay, so, oh gosh, I wish we had more time because that's a big question, but I'll just try to briefly tell you what it means to me. To me, success means the measure of enjoyment that you can derive from any one particular situation, because there's a real misunderstanding, in my opinion, about the value of money and the value of items. People measure them in terms of cost, in terms of price. I think that's a very big mistake. I think items need to be measured in terms of enjoyment, pleasure that you can derive from them. And there's this kind of inflationary process where the more items you have, the less you enjoy them. So it's kind of also counterintuitive in this terms that people are seeking pleasure. They're running after more expensive items. They don't realize that just lowers the value. It doesn't bring them any lasting pleasure. It just lowers the value of everything else they have in their eyes. So I think we need to stop. We need to start appreciating the things that we do have in life, like the ability to see, breathe, talk, derive pleasure out of those, because those are immensely pleasurable items. The ability to speak, think how frustrated we would be if we wouldn't be able to communicate, talk, see, walk, eat. That invaluable. So let's start squeezing pleasure out of items that we have around us that are extremely cheap monetarily, and that's what I would say.
That's awesome. Yeah, success. Absolutely. No, 100%. Success on the kind of micro successes, really, because like you said, there's so much to be grateful for. There's so much that we have. God has created this beautiful world, and the fact that we have hands and eyes and nose and molecules in our bodies that are just allowing us to live and be alive and experience everything through all our senses. So tapping into that is, true success, true pleasure. So I like that. I like the definition. I'm going to take that one a little more deeply today.
I think that's something that people that especially in the business world, I believe this audience is more in kind of the real estate / business world, and I think that's something that is important for people to remember. If I would have to leave a message with you, I think that's important to remember. And I have noticed that a lot of thinkers and CEOs like Bill Gates and others have kind of reached that through a lot of thinking, tremendous wealth, and that they've come to this place where essentially it's just deriving pleasure and enjoyment of the things that are around us.
Right, from the seemingly little things in life that we take for granted, and I appreciate that. So, David, where can people find you if they want to reach out to you?
So, if they want to find me personally, I live in Rockland County, New York, upstate, about 30 miles from Manhattan. If they want to reach out to me, they can give me a shout out. My personal email, david@arionfund.com. That's probably the best place.
Awesome. Incredible. I appreciate you coming out here today. It's always a pleasure speaking with you, whether on camera or off camera, right? Whether it's, spending time with you and your family or, just hanging out. So I appreciate you. Thanks for coming, and hope we can do this again soon.
Absolutely. You're very welcome. Thank you so much for having me, Yona.
And again, in person, hopefully very, very soon. And for all you listeners, I appreciate you tuning in once again. This has been Weiss Advice. It's been a pleasure. And remember, the best advice comes only when you ask. Real quick, I have one question for you. Did you like this episode? If you did, I want to ask you a huge favor. See, the biggest thing that helps this podcast grow and that will spread this message to the whole world is that if you leave a review, a rating, and subscribe to the podcast. What that does is it basically tells the platforms that this podcast is out on is that you like my stuff and I'm doing something right. So take a few seconds out of your day, hit that subscribe button, leave a rating or review. I would be extremely grateful. Also, I want to hear from you guys. So I want to hear some feedback. If you have any questions for future episodes, please find me on LinkedIn. Send me a DM, a connection request, Yona Weiss, and I'd love to hear from you.